They are panicking. Emergency weekend meeting revealed $80 silver. The markets are closed, the trading floors are empty. But inside the boardrooms of lower Manhattan right now, something is happening. Emergency meetings at the highest levels of the global financial system. Why? Because silver just crossed $80 and moved 10% in a single day. And when a core commodity moves that fast, it doesn't just shake the market. It breaks things. It breaks the risk models, the margin requirements, and most dangerously, it threatens the entire clearing system. The banks are meeting this weekend, not because they are in control, but because they have lost it. They know if silver gaps to $85 on Sunday night, the game might be over. This is the story of the weekend the system blinked. Welcome to Financial Announcement, where we decode the signals the mainstream media won't touch. If you appreciate this kind of strategic economic analysis, the kind that helps you see around corners before the crisis hits, then do us a favor. Subscribe to this channel. Think of it this way. You've lived long enough to know that the real story is never in the headlines. It's in the boardrooms, the emergency calls, the weekend meetings nobody talks about. That's what we bring you here. And tell us, where are you watching this from right now? Are you in New York, London, Singapore, Mumbai? Drop your location in the comments. Because what's happening in the silver market this weekend isn't just an American problem, it's a global reckoning. Now, let's expose what's really happening behind those closed doors. The financial world operates on a simple principle. When the markets are open, everyone watches the screens, but when the markets close, when the holiday weekend begins and the traders go home, that is when the real decisions are made. Right now, as families gather and people rest, a very different scene is unfolding. In the glass towers of lower Manhattan, in the secure conference rooms of the Federal Reserve, in the executive suites of the largest banks in the world, meetings are taking place. Emergency meetings. The kind that do not appear on any public calendar. These are not routine discussions. These are crisis management sessions. And the crisis has a name, silver. On Friday, silver closed at 79.25, but that number tells only half the story. What matters is not where it closed, but how it got there. Silver moved 10% in a single trading day. To most people, that sounds like just another market fluctuation. But to the people in those boardrooms right now, it is something far more dangerous. A 10% move in a core commodity is not a trading event. It is a solvency event. Let the audience understand what that means. When silver moves 10% in one day, it does not just affect the people who trade silver. It affects the entire structure of the financial system. Because silver, like most commodities, is not traded with cash. It is traded with leverage, borrowed money. And when the price moves against that borrowed money, things break. Here's the mathematics that has the banks panicking right now. Most large institutions trade silver with leverage ratios of 20 to 1, sometimes even 50 to 1. This means for every dollar they actually have, they're controlling $20 or $50 worth of silver. When the market is calm, this creates enormous profits. But when the market moves violently, leverage becomes a weapon of mass destruction. The math is brutal. If a bank is leveraged 20 to 1 and the price moves just 5% against them, they lose 100% of their equity. They are wiped out. Their capital's gone. They owe money they do not have. Silver moved 10% on Friday. That means any entity, any bank, any hedge fund, any large trader that was leveraged 10 to 1 or higher on the short side is now technically insolvent. Their equity has evaporated. They are underwater. They owe billions they cannot pay. Under normal circumstances, the solution is simple. The bank issues a margin call. They demand the client deposit more money immediately, or they liquidate the position, force them out, close the trade, take the loss. But what happens when the client is too big to liquidate? What happens when the client is not some small hedge fund, but a massive industrial corporation that needs silver for manufacturing, or a sovereign wealth fund representing an entire nation, or worse, another bank? The answer is, the banks cannot simply liquidate, because forcing that liquidation would crash the entire market. The selling pressure would be so massive that silver would gap down violently, triggering more margin calls, more forced liquidations, more panic. This is what financial professionals call a cascade event. One failure triggers the next, which triggers the next, until the entire system is at risk. So instead of liquidating, they hold meetings. They call the regulators, they call the Federal Reserve, they call the Treasury Department, they call the Commodity Futures Trading Commission, and they say, we have a problem. If the market opens on Monday morning and silver continues rising, Bank X is going to default. We need a solution. This exact scenario has played out before. In 2008, it was Bear Stearns. Emergency weekend meetings, emergency bailouts, rule changes. In 1998, it was long-term capital management. Same pattern, weekend negotiations, coordinated intervention. In 1980, it was the Hunt brothers and the silver market. Emergency rule changes to stop the bleeding. History is repeating itself right now, this weekend. But there is something different this time. The meetings are not just about saving one client or one bank. They are about something much bigger. They are about the clearinghouse. The clearinghouse is the central spine of the commodity markets. It guarantees every single trade. When a buyer and seller agree on a price, the clearinghouse stands between them. It ensures that if one side cannot pay, the system still functions. But the clearinghouse is not invincible. It has a default fund, a pool of money contributed by all member banks. This fund is the insurance policy. If one member fails to pay, the fund covers the loss. The problem? With silver at $80 and potentially heading to $85 or higher, the losses are measured in billions. If the price gaps up again on Sunday night, the losses could exceed the entire size of the default fund. And if that happens, the clearinghouse itself is at risk. When the clearinghouse is at risk, the entire market is at risk. That is why they are meeting this weekend. That is why they are panicking. Because they know if they cannot contain silver before the market opens, the contagion begins. There's a reason why these emergency meetings always happen on weekends. It is not coincidence. It is not random scheduling. It is strategy. Because weekends give them something they desperately need: time. Time to coordinate. Time to lawyer up. Time to change the rules before anyone notices. The general public wakes up Monday morning, checks the market, and sees new regulations in place. Higher margin requirements, position limits, trading restrictions, and they accept it as normal market function. They never see the panic that happened behind closed doors. They never hear the desperate phone calls. They never read the legal memos written at 2 a.m. on Sunday morning. But the pattern is there, clear as daylight, for anyone willing to look at history. March 1980, silver is trading near $50 per ounce. The Hunt brothers, two billionaire brothers from Texas, have been accumulating massive positions in physical silver and silver futures. They are convinced silver is going to $100, maybe $200. They are leveraged heavily, and they are winning. Until they are not. On a Sunday evening, the COMEX exchange announces emergency rule changes. They call it Silver Rule 7. The new regulation limits how much silver any single entity can hold. More importantly, it restricts new purchases. Traders can only liquidate positions, not add to them. The buy button effectively turned off. Monday morning, silver crashes. The Hunt brothers cannot meet their margin calls. They go bankrupt. The crisis is contained. The system survives. And the history books write it off as reckless speculation being properly regulated. But here is what the history books do not emphasize. The rules were not changed before the crisis. They were changed during the crisis, in the middle of the game, to save the banks that were on the other side of the Hunt brothers' trades. Fast forward to September 1998. Long-term capital management, a hedge fund run by Nobel Prize-winning economists, is on the verge of collapse. They have leveraged positions across every major market: interest rates, currencies, stocks, bonds. And they are losing on all of them simultaneously. If LTCM fails, it will trigger margin calls across 14 major banks. The forced liquidations could crash multiple markets at once. It is not just one fund at risk. It is the entire interconnected web of the global financial system. What happens? Weekend meetings. The Federal Reserve Bank of New York organizes a private bailout. 14 banks contribute $3.6 billion to take over LTCM's positions. The fund is dismantled in an orderly fashion. No panic, no contagion. Crisis averted. But notice the pattern. The meeting happened on a weekend. The solution was implemented before the markets opened. The public never saw the panic. They only saw the press release about orderly resolution. March 2008. Bear Stearns, one of the oldest investment banks on Wall Street, is collapsing. They are overleveraged in mortgage-backed securities. They cannot meet their obligations. If they fail on Monday morning, the domino effect could take down half of Wall Street. What happens? Emergency weekend negotiations. The Federal Reserve arranges a buyout. J.P. Morgan Chase acquires Bear Stearns for $2 per share, a company that was trading at $170 just a year earlier. The Fed provides $29 billion in guarantees to make the deal happen. Again, weekend meetings, emergency intervention, rules bent, system saved. March 2022. The London Metal Exchange faces a crisis in nickel trading. The price of nickel doubles in a single day, then doubles again. A massive Chinese trader is short nickel and facing losses of over $10 billion. If they default, it could bring down their brokers and potentially the entire exchange. What does the LME do? They halt trading. Then they do something almost unprecedented. They cancel trades. Billions of dollars in transactions that already happened, erased. Traders who were winning suddenly have their profits deleted. The excuse? Maintaining orderly markets. But the real reason? preventing a default that would have destroyed the clearing system. The pattern is undeniable. When the leverage gets too extreme, when the losses threaten the system itself, they meet on weekends, they coordinate, they change the rules, they do whatever is necessary to protect the structure, even if it means destroying the fairness of the market. And here is what makes the current silver situation so dangerous. Every single one of those historical crises involved leverage, short positions, and weekend meetings. The mechanics are identical. The banks are short. The price is moving against them. The losses are existential. And they are meeting right now, this weekend, to figure out how to survive Monday morning. But there is one critical difference this time. In 1980, the internet did not exist. In 1998, social media did not exist. In 2008, retail trading was still a niche activity. In 2022, the public was watching, but they were not yet organized. In 2025, everything is different. Millions of retail investors are watching silver in real time. They are communicating on forums, social media, messaging apps. They are coordinating. They're educated about the historical patterns. They know about the Hunt brothers. They remember the LME nickel scandal. They watched what happened with GameStop. The banks can still change the rules. They still have the emergency powers. They can still raise margins, halt trading, impose position limits. The legal framework gives them that authority. But this time, everyone will see it happen. Everyone will know it was manipulation, and everyone will remember. The question is not whether they will intervene. The question is whether their intervention will work, or whether it will accelerate the very crisis they are trying to prevent. Because there is one thing they cannot control with rule changes and margin hikes. They cannot control the physical market. They cannot control the buyers in Shanghai who do not care about COMEX rules. They cannot control the individuals walking into coin shops and paying premiums for physical silver. If they shut down the paper market, the physical market simply decouples. The price in Asia goes to $100. The price in New York stays frozen at $79. And every ounce of physical silver flows east, draining the Western vaults empty. They are trapped. And they know it. That is why they are meeting this weekend. Not because they have a solution, but because they are desperate to find one before the Asian markets open Sunday night. There is a document that most traders never see. It sits in the legal archives of every major commodity exchange, buried in the fine print of trading agreements, hidden in the appendices of regulatory frameworks. It is called the Emergency Powers Provision. And right now, lawyers are reading it very carefully. This document gives exchanges and regulators extraordinary authority during market emergencies. Authority that can override contracts, authority that can change the rules retroactively, authority that can, in extreme circumstances, halt markets indefinitely. The public believes markets operate on fixed rules, that contracts are sacred, that a trade executed today will settle tomorrow according to the agreed terms. But that belief is conditional. It depends on the system remaining stable. And when stability is threatened, the rulebook changes. The people meeting this weekend are not just bankers and regulators. They are lawyers, constitutional lawyers, contract lawyers, international trade lawyers, because what they are about to do needs to be legally defensible, or at least defensible enough to survive the inevitable lawsuits. Here's their toolkit, the weapons they have used before, the weapons they will likely use again. Weapon number 1, margin requirement increases. This is the most common intervention, the cleanest, the least controversial on the surface. The exchange simply announces that, starting Monday morning, traders need to post more collateral to hold their positions. Instead of 10% margin, it becomes 20% or 30%, or in extreme cases, 100%. What does this accomplish? It forces traders to make a choice. Either deposit massive amounts of new capital immediately, or close the position. For retail traders with limited capital, it effectively forces liquidation. They cannot meet the new requirement. They have to sell. And when they sell, the price pressure reverses. In 1980, COMEX raised silver margins repeatedly. Each time, it squeezed the Hunt brothers harder. Each time they had to liquidate more positions, until finally, they collapsed. But here's the problem with this weapon in 2025. Retail traders are no longer the only players driving silver higher. There are institutional buyers, sovereign entities, Asian manufacturers locking in supply. These players have deep capital. A margin increase might slow them down, but it will not stop them. Weapon number 2, position limits. This is where the exchange declares that no single entity can hold more than a specified number of contracts. If a trader is above that limit, they must reduce their position immediately. This weapon is surgical. It targets the largest players specifically, the whales, the entities moving the market. The exchange can effectively force them to sell, not because they want to, but because the rules now prohibit them from holding that much. In 1980, this was Silver Rule 7, the regulation that broke the Hunt brothers. They were not allowed to hold their positions anymore. Liquidation became mandatory. But this weapon has a weakness. It only works on the futures market. It only applies to paper contracts traded on regulated exchanges. It cannot touch physical silver held in private vaults. It cannot touch purchases made in Shanghai or Hong Kong or Mumbai. And if large players simply move their capital from paper to physical, the intervention fails. Weapon number 3, liquidation-only trading. This is more extreme. The exchange announces that for a specified period, traders can only close positions. They cannot open new ones. The buy button is turned off. Only selling is allowed. This creates artificial selling pressure. Every trade becomes one-directional. Prices fall, not because demand decreased, but because supply is the only option. It is market manipulation by design, but it is legal manipulation because the exchange has emergency authority. The London Metal Exchange used this weapon in 2022 with nickel. They did not just halt trading. They restricted what type of trading could resume. Weapon number 4, trading halts. This is the nuclear option. The exchange simply stops trading entirely. No buying, no selling. The market freezes, prices freeze, positions are locked. This gives them time. Time to negotiate with the largest holders, time to arrange orderly liquidations, time to coordinate bailouts if necessary, but it comes with enormous reputational cost. Because when an exchange halts trading, it admits it has lost control. The LME halted nickel trading for a week in 2022. When it reopened, trust was shattered. Trading volumes never fully recovered. Participants started looking for alternatives. The damage was permanent. Weapon number 5, and this is the most controversial, retroactive trade cancellations. The exchange declares that trades executed during a certain time period are void. They are erased from the books. Profits disappear. Losses disappear. Everything resets to before the chaos began. The LME did this with nickel. Billions of dollars in trades canceled. Traders who had won lost their winnings. Traders who had lost were given a second chance. It was unprecedented. It was legally questionable. But it was done anyway, because the alternative was exchange insolvency. So which weapons will they use this weekend? The answer is probably all of them, in sequence, escalating as needed. They will start with margin increases, announce them Sunday evening, make them effective Monday morning, see if that slows the momentum. If silver still gaps higher, they impose position limits, force the largest holders to reduce. If that fails, they go to liquidation only, turn off the buy button. If the selling pressure still is not enough, they halt trading entirely. And if none of that works, if the physical market decouples and the paper market becomes irrelevant, they will be forced to let the paper market fail while pretending it represents real prices. But here is what they cannot admit publicly. Every weapon they use proves the critics right. It proves that the market was never free. It proves that prices were never determined by natural supply and demand. It proves that when the system is threatened, fairness is abandoned. And that proof will accelerate the very trend they are trying to stop. Because each intervention pushes more investors away from paper and toward physical. Each rule change confirms that the game is rigged. Each emergency measure validates the thesis that the system cannot survive honest price discovery. They have the weapons. They have the authority. They have the legal framework. But they do not have credibility anymore. And in the long run, credibility is the only weapon that actually matters. The meetings this weekend are not about finding a permanent solution. They are about buying time. Another week, another month, another quarter. Postponing the inevitable collapse of a paper market built on leverage it can no longer sustain. They will use their weapons. They will change the rules. They will claim they are protecting market integrity. But everyone watching will know the truth. They are not protecting the market. They are protecting themselves. And that difference is everything. There's a moment in every financial crisis when the narrative shifts, when the people who were supposed to be in control realize they are not, when the tools that always worked before stop working, when the playbook that saved the system in 1980, in 1998, in 2008 becomes irrelevant. Silver at $80 is not that moment, but silver at $80 is the warning that the moment is coming. Right now, in those emergency meetings, they are running scenarios, computer models, stress tests. They're asking the same questions over and over. What happens if silver opens at $85 on Sunday night? What happens if it reaches $90 by Tuesday? What happens if Shanghai decouples from New York and physical premiums explode to 30% above spot price? But here's the question they are not asking, because it is too terrifying to ask. What happens if this is not about silver at all? Let them understand what that means. Silver is not moving in isolation. Gold hit 2,700, then broke through to new all-time highs. Platinum is stirring, palladium is volatile, copper is climbing, oil is unstable. Wheat prices are elevated. The entire commodity complex is showing stress. This is not a silver squeeze. This is a currency crisis wearing a silver mask. When one commodity moves 10%, it can be explained away. Speculation. A short squeeze, market manipulation, temporary imbalance. But when the entire commodity sector starts moving in the same direction, when hard assets across the board begin repricing higher, that is not speculation. That is the market voting against something. And what they are voting against is the value of the currency those commodities are priced in. The dollar is not collapsing. Not yet. But confidence is cracking. And confidence is the only thing holding the current monetary system together. Here's the mechanism they do not want anyone to understand. The banks that are short silver are not just short silver. They are short commodities broadly. They have leveraged positions across dozens of markets. Because for years, commodities were a one-way bet. Governments printed money, central banks suppressed interest rates, and commodities stayed range-bound. Easy profits for anyone willing to sell volatility and collect premiums. But that trade only works in a deflationary psychology. It only works when people believe paper assets are safer than hard assets. It only works when confidence in the system remains intact. That confidence is breaking. Not everywhere, not all at once, but in pockets, in specific markets, in specific countries. Wealthy individuals in China are buying gold. Central banks in emerging markets are diversifying reserves. Pension funds are adding commodity exposure, quietly, steadily, without making headlines. And then silver moves 10% in one day. And suddenly the quiet trend becomes a visible crisis. So when the banks meet this weekend to discuss silver, they are really discussing something much larger. They are discussing whether the paper commodity markets can maintain credibility, whether the price discovery mechanism can survive, whether the leverage that has generated decades of profits is about to turn into decades of losses. Now let the business community understand why this matters to them. Most CEOs are not commodity traders. Most entrepreneurs do not follow silver prices. Most business leaders think this is a Wall Street problem that does not affect Main Street. They are wrong. Silver is in everything: electronics, solar panels, medical equipment, batteries, industrial machinery, electrical contacts, water purification, photography. If silver reprices from $80 to $120, it does not just hurt traders. It restructures entire supply chains. A solar panel company that budgeted for $25 silver suddenly faces $120 silver. Their margins evaporate. They cannot pass the full cost to customers without losing competitiveness. They cannot absorb the cost without bleeding cash. They are trapped. A medical device manufacturer using silver and antimicrobial coatings faces the same calculation: raise prices and lose market share, or maintain prices and destroy profitability. There is no good option, and that is just silver. Now multiply that across copper, lithium, nickel, cobalt, rare earth elements. If the entire commodity complex reprices higher, the cost structure of the modern economy shifts. Products that were profitable become unprofitable. Business models that worked for 20 years suddenly do not work. This is why the emergency meetings are happening. Not because silver moved 10%, but because silver moving 10% is the crack in the dam. And if the dam breaks, the flood affects everyone. But there is something else the business community must understand: the policy response. What governments and central banks will do when commodity inflation returns. Because they only have three options, and all of them are painful. Option 1, raise interest rates aggressively, crush demand, force a recession, make borrowing so expensive that economic activity slows and commodity prices fall. This is the Paul Volcker playbook from 1980. It worked. It stopped inflation. But it also caused unemployment to hit 10%. Small businesses failed by the thousands. It was economically devastating. Option 2, price controls. The government simply declares that certain commodities cannot be sold above a certain price. This prevents inflation in consumer prices, but it destroys the production incentive. Why mine silver at $30 when it costs $40 to extract? Producers shut down. Supply disappears. Shortages emerge. The 1970s tried this. It failed spectacularly. Option 3, let it run. Accept that commodity prices are going higher. Accept that inflation is returning. Try to manage it with fiscal policy and hope wages eventually catch up. This is the path of least resistance politically, but it destroys savings, pensions, and fixed income investments. The meetings this weekend will not decide which option to choose, but they will decide how much time they have before that choice becomes unavoidable. Now here is the scenario that keeps central bankers awake at night. What if the physical commodity markets simply disconnect from the paper markets entirely? What if Shanghai silver trades at $100 while COMEX silver is frozen at $79 with trading halted? What if physical gold premiums in India reach 20% above spot while London prices are capped by regulation? This is not theoretical. It has happened before in smaller markets. It is happening right now with Russian commodities trading at different prices in different regions. The global price discovery mechanism is already fragmenting. If it fragments completely, if East and West start pricing commodities differently, the entire structure of global trade changes. Arbitrage becomes impossible. Contracts become unenforceable. Supply chains that depend on predictable pricing collapse. And that is the real crisis. Not that silver went to 80, but that $80 silver revealed how fragile the pricing mechanism has become, how dependent the system is on everyone agreeing to pretend that paper contracts represent real metal, how quickly that pretense can evaporate when tested. So when Monday morning comes, watch what they do. If margins are raised modestly and trading continues normally, it means they believe this is containable, a temporary spike, a speculative excess that will fade. But if margins are raised dramatically, if position limits are imposed suddenly, if trading is halted or restricted, it means they are terrified. It means they know this is bigger than silver. It means they are buying time because they have no solution. And if the physical market decouples, if premiums explode, if Eastern prices diverge from Western prices, then the game has changed permanently. The paper market has failed, and the repricing of everything has begun. The weekend meetings are not about saving silver. They are about saving the illusion that paper markets still matter, that leverage still works, that the system can survive honest price discovery, but illusions only work when everyone believes them. And belief is the one thing central banks cannot print.